The first budget is always the sales budget. We need to do this one first because we won't know how many units to make or what to purchase if we don't know what we plan on selling. In order to prepare this budget, analysts will look at economic and market conditions, the capacity of the business, because you cannot produce more than you can make, and advertising plans. They will also look at past performance data. Don't worry, you won't have to do any of the analysis in this course. What you need to do is use this information to prepare the budget. Preparing the sales budget is extremely easy to do. You would multiply how many units you plan to sell by the selling price. That's it. Please also note that all the budgets we are doing in this course are very basic. Companies that have many products will have a much more extensive sales budget. Let's do an example for this budget next. This is number 1 on your classwork. Make sure to fill it out and follow along. You can also pause this problem now to see if you can do it on your own. We have Scora Inc. They're preparing its master budget for the quarter ending May 31st. It sells a single product for $50 per unit. Budgeted sales for the next 3 months follow. Prepare a sales budget for the months of January, February, and March. We have the amount of units we plan on selling in January, February, and March. We also know that we sell these units for $50 per unit. Like I said before, this is really easy to do. First, we want to put in how many units we plan on selling, and then we want to multiply it by the unit price times. This will equal our budgeted sales. The amount of units we plan on selling for January are 1,200. The budgeted unit price is $50. We will multiply these numbers. 1,200 times 50 equals 60,000. February, same thing. How many units do we plan on selling? 2,000 units multiplied by how much we sell it for, 50, will give us sales of $100,000. Finally, for March, 1,600 is the amount of units we plan on selling, times the $50 we charge for each unit. So in March, we think we will make $80,000. You can add everything up to get the totals for the whole quarter. We'll be selling 4,800 units for a total sales of $240,000. Next, we'll discuss the production budget. This budget shows a number of units to be produced in a period. We need to make enough units to cover our sales, and we usually want to make extra so that we have enough units on hand to make sales at the beginning of the next period. For example, if we think we sell 2,000 printers this month, we don't want to make exactly 2,000 printers. This is because at the beginning of next month, we won't have any finished units on hand to sell. If it takes a few days to make a printer, then we will be a few days behind in our sales. The other thing to consider is that since we do always start with some units on hand, then we don't have to make all of them each month. If we needed to make 2,000 units for this month for our sales, last month we would have made some extra for this month. If we made some extra, then we don't have to make all of them for this month. You always want to consider how many sales you're making for this month, plus the extra you want for the following month, minus any you already had on hand, the extra you made from the prior month. This can also be done on a yearly basis or quarterly basis. I'm just using a month as an example. Therefore, we will use our sales information along with our inventory guidelines. The outcome of this budget will be how many units we need to produce for each time period. A simplified formula on how to calculate this is the ending inventory plus sales units minus the beginning inventory. The ending inventory is how many units we want on hand at the end of the time period to begin the next period with. Sales units is the amount of units we plan on selling this month. Beginning inventory is the units we already had on hand at the start of this period. These were the units made extra from the last time period. Let's do an example together. This is number 2 on your classwork. We have Forest Company, who manufactures phone chargers and has a policy that ending inventory must equal 10% of the next month's sales. Therefore, we want 10% of what we think we're going to sell next month made prior. It estimates that October's actual ending inventory will consist of 40,000 units. November and December sales are estimated to be for 100,000 and 350,000 units, respectively. Compute the number of units to be produced that would appear on the company's production budget for the month of November. First, we need to calculate the ending inventory units. These are the units we want on hand for the following month of December. We want 10% of next month's on hand. In December, we plan on selling 350,000 units. Therefore, we want to make 10% of that in November. 10% of 350,000 is 35,000. Next, we want to add the amount of units we need to make for this month. We're currently in November. We plan on selling 400,000 units. Therefore, we need to make those 400,000 units. We add these numbers together. Our requirement so far is 435,000 units. Lastly, we'll subtract the amount of units we already had on hand. It states up here that October's actual ending inventory will consist of 40,000 units. Therefore, October ended with 40,000 units, so November started with 40,000 units. This is how many we had on hand. It is also 10% of what we planned on selling. We subtract this because we don't need to make these 40,000 units because we already had it on hand. 435,000 minus 40,000 equals 395,000. For the month of November, we need to make 395,000. This will cover this month, plus a little bit for next month, minus what we already had on hand. The next budget we will discuss is the direct materials budget. The direct materials budget shows the budgeted cost for the direct materials that will need to be purchased to satisfy production. We need to do the production budget first. Once we know how many units we're going to produce for each month, then we can figure out the materials we need to buy for each month or each time period. This budget will show us both the quantity, how many materials to buy, and the cost, how much it will cost us for these materials. The formula is the materials required for the production plus the budgeted ending materials minus the materials in the beginning inventory. Very similar to the last budget we did. The materials needed for production would be how many materials we need to purchase for the current time period, let's just say the current month, plus the budgeted ending materials. These would be the materials we want to purchase to have on hand for the following month, minus the materials in the beginning inventory. This is what we already had on hand at the start of this time period. These would be the ending materials from the last time we did this. Let's do an example with this one. This is number 3 on your classwork. We have a Zortec Corp who budgets production of 400 units in January and 200 units in February. Each finished unit requires 5 pounds of raw material Z, which costs $2 per pound. Each month's ending inventory of raw materials should be 40% of the following month's budgeted production. The January 1st raw materials inventory has 130 pounds of material Z. Prepare the direct materials budget for January. I would say that out of all the budgets that we're going to be preparing, this one is probably the most complicated one. We begin using the budget production units. How many units do we need to produce for the month of January? Zortec budgets production of 400 units in January. The first line would be the 400 units. Now we have to figure out how many materials we need to make those 400 units. What is the materials requirement per unit? It's 5 pounds of our material Z. 5 pounds. How much materials do we need to purchase, how many pounds, in order to make these 400 units? For this one here, you would multiply 400 units times 5 pounds equals 2,000 pounds. That's our first step. Our second step is to add the budgeted ending inventory requirements. How many pounds of this material do we need to purchase to satisfy what we want at the end of the month to cover the beginning of February? If you look at the problem, we would like 40% of the following month's budgeted production on hand. Therefore, whatever we need to make in February, we need to calculate how many materials that is, and we only want 40% of that to be purchased in the month of January. This is probably the most complicated number to find on this whole budget. We think we're going to produce 200 units for February. We need 5 pounds of material for each of those units, and we only want 40% of that to be made in January. Therefore, you will multiply all these numbers together. 200 units for February times 5 pounds of this material for each of those units. And we only want 40% of that to be purchased during this month, the month prior. 200 times 5 times 40% equals 400 pounds. We add this together, the 2,000 pounds plus the 400 pounds. So far, our requirement is 2,400 pounds of this material. Our last item to figure out is how many pounds of this material we had on hand at the beginning of this time period. It states in the problem the January 1st raw materials inventory had 130 pounds of this material Z. Our beginning inventory would then be this 130 pounds that we already had on hand. We will subtract this to figure out how many materials need to be purchased. 2,400 minus the 130 equals 2,270 pounds of this material. That's the first number we want to figure out. We want to figure out the quantity of materials. The next item we want to figure out is how much will this cost us? How much is the materials price per pound? It's $2 per pound. We will multiply this. We need to purchase 2,270 pounds of material Z at a cost of $2 per pound. When you multiply that, it'll cost us a total of $4,540. The next budget is the direct labor budget. The direct labor budget is pretty easy to do. It shows the cost for direct labor that will be needed to satisfy the production. Once again, we need to do the production budget first to know what we're going to spend on our employees making these products. Remember, this is just direct labor, those who are directly working on the product. The manager's salary and other employees who are not working on the product would not be included with this budget. The formula is very simple. How many units we plan on producing times the time per unit. Does it take us 1 hour, 2 hours, 6 hours to make it? The time unit. Times how much we pay our employees per hour on average. Once again, this is a very simplified structure for this budget. Companies that have many employees and many different products will have a much more extensive looking budget. Let's do a practice with this one. This is number 4 on your classwork. We have Tora Co., who plans to produce 1,020 units in July. Each unit requires 2 hours of direct labor. The direct labor rate is $20 per hour. Prepare a direct labor budget for July. I do recommend pausing this right now and trying it on your own since this is an easier budget to do. We begin by putting in a budget production in units. How many units are we planning on producing for the month of July? 1,020 units. What are the labor requirements? It takes us 2 hours to produce each unit. We multiply these to find out the total hours needed. To make 1,020 units, it will take 2,040 hours. We need to pay our employees for 2,040 hours in order to make these units. What's the direct labor rate per hour? It's $20 per hour. We multiply the 2,040 hours by the $20. We get a total cost of $40,800. To make the 1,020 units, it will cost us $40,800 in labor costs. As a reminder, direct labor would be those who were physically working on making the product, like the assembly line workers. Managers, supervisors, those in offices would not be included with this number. Those salary costs are part of overhead, which is the next budget we will discuss. The factory overhead budget shows the budgeted costs for factory overhead that are needed to complete production. This would be the variable costs that we learned last chapter, along with the fixed costs. Once again, this budget becomes more complex with larger companies. Our textbook has a very simplified version of this budget to the point where I don't have a classwork problem for this one, but I do have an example. Once again, this is not one of your classwork problems. We have Hockey Pro, who budgets production of 3,900 hockey pucks during May. The company assigns variable overhead at the rate of $1.50 per unit. Fixed overhead equals $46,000 per month. Prepare a factory overhead budget for May. Once again, we're adding the variable costs plus the fixed costs. Remember, the variable costs change depending on how many units we produce. The more we produce, the more our variable costs will increase. If we're producing 3,900 units, variable cost is $150 per unit. We will multiply this together to get our total variable costs. 3,900 units times $1.50 per unit is $5,850. Next, we'll add our fixed costs, which is $46,000 per month. Remember, this one doesn't change. Therefore, each month it would be $46,000 every month. Only the variable cost would change. We add these two numbers together and we get $51,850. This would be our factory overhead budget for the month of May. On this next slide, I have a few other budgets grouped together. First is the selling expense budget. This is an estimate of the types and amounts of selling expenses expected. We do have a practice problem with this one next. The other budgets are fairly simple and similar to this one, so we won't be doing any practice problems with them, but I do want to go over it. We have the general and administrative budget. This plans the predicted operating expenses that are not already included on the other budgets. This is usually the variable plus the fixed costs for general and administrative items added together. We also have the capital expenditure budget. This shows the dollar amounts estimated to purchase plant assets and amounts to be received from asset disposal. This budget is usually prepared for a much longer time period than the other ones. It could be for a year, but could also be for 5 years, 10 years, or longer. For example, OCC has a capital expenditure budget, It has all the buildings that they plan on either renovating or building new for the next 10 years. We will now go over the selling expense budget. This is number 5 on your classwork. We have Zilly that predicts sales of $400,000 for June. Zilly pays a sales manager a monthly salary of $6,000 and a commission of 8% of that month's sales dollars. Prepare a selling expense budget for the month of June. Part of this budget is variable and the other part is fixed. The commission part would be variable. Each month, the expected sales would change, therefore, the commission would also change. The salary, that's $6,000, would be the fixed cost, and that wouldn't change month to month whether the sales increased or decreased. The first part is calculating that variable portion, and then we'll add the fixed portion to it. To calculate the variable portion, we'll first begin with the budgeted sales for the month. How much is that? It would be the 400,000. We will then multiply that by the sales commission, which is how much? It's 8%. And when you multiply that, you get 32,000. We have the two columns here. One is just to calculate the number that we use here. Like I said, this is the variable cost because each month it would be something different based on our sales. We'll then add the monthly salary, which is the fixed portion, which is how much? 6,000. Altogether, it would be $38,000.